Good afternoon, everyone. And I think people are just joining, so we'll just give it a few seconds. But while we do that, I'll just welcome everybody to this discussion this afternoon on leveraging transaction monitoring in the battle against financial crime. I'm delighted to be moderating today's session and very glad. Thank you for joining us. We're gonna spend about 45 minutes to 50 minutes today. Discussing this topic. Feel free to drop in your questions to the chat as we go as well. We're going to do our very best to pick those questions up as we go, but if we don't, we'll try and pick them up at the end of the discussion as well. My name is Matt Neal. I'm one of the co-founders of Beyond, a specialist consulting firm focused on helping financial institutions to accelerate and deliver business and digital transformation, and also co-founder of the Fintech Innovation Network, where we're looking to help financial institutions navigate this increasingly complex world of technology and innovation within financial crime. Our discussion today is focused on transaction monitoring and its use within financial institutions for preventing financial crime. I'm delighted to welcome a fantastic panel today. We've got Andrew Dawson, Colin Whitmore, and Shaun Smith-Taylor with us. Gents, would you be so kind to introduce yourself and provide just a very brief description on your experience in transaction monitoring and financial crime, and then we're going to jump into the discussion. So, Colin, is it all right if I come to you first?
Yes, certainly. Thank you, and thanks for having me along. And hello to everyone. I'm Colin Whitmore. I currently work for NatWest Bank. My role varies strategy, innovation, and design for transaction monitoring. I've got a background in transaction monitoring, strategy, design, implementation of solutions, design of solutions, and also spent quite a lot of time looking at fintechs, innovation, and how we can apply artificial intelligence and other techniques to some of the issues we're going to no doubtly discuss today. So that's me. Thank you.
Brilliant. And Andrew, would you like to go next?
Sure. My name's Andrew Dawson. Thanks for the opportunity to be here. I started out in fintech around 10, 12 years ago with 𝗵𝗶𝗆 in second line AML role, moved to various other organizations such as 𝗬𝗁𝘁𝗁𝗃𝗃, and 𝗺𝗶H, which is a Chinese payments company. And in 2019, joined 𝗂𝗏𝗃 as MLRO. My background is more focused on fintechs that provide services to other fintechs. So maybe I'm taking it a slightly different kind of viewpoint than the others in that the due diligence process I apply is akin to something in correspondent banking. That's the kind of viewpoint I'll be taking it from. 𝗂𝗏𝗃 provides services to other fintechs via banking services. So you're providing payment services that behind fintech products to other fintechs, and therefore we're not potentially having a direct relationship with the end user of the payment services. I'll be taking it from that perspective, and a more of a kind of second line AML perspective, in that I'll be talking about governance, management information, and the things that the second line will need from a kind of technological standpoint.
Great. And certainly, last but not least, Shaun, would you like to give the intro?
Sure, thank you. So yeah, hi, I'm Shaun Smith-Taylor. I've worked within, I probably come more from a product technical perspective within compliance, but I've worked for Lloyds Banking Group. I worked actually with Andrew, 𝗵𝗶𝗆𝗃𝗃 plc, moved to banking as a service provider, and now I actually work for an artificial intelligence provider called ThetaRay's, who specialize in transaction monitoring and transaction screening solutions, but again, from an artificial intelligence perspective, so the newer technology. But like I said, I come from a product technology perspective, so really looking forward to discussing, you know, what looks good, and also, I guess, what can be improved.
Okay, great. So I guess to dive into the discussion, I want to kind of just set the scene a little bit in terms of why transaction monitoring is important. So maybe, Colin, if I come to you first, but why is transaction monitoring so important now for financial institutions, and why is it important that we're talking about it today from your point of view?
Yeah, absolutely. It's critical for financial institutions as part of their financial crime control framework and their prevention of financial crime. You know, it's a fundamental backstop to how they detect and identify unusual activity, suspicious activity off the basis of that, how they're reporting it to their regulators in country or globally, and also how they can understand their customers' behavior to say, you know, our customers, are there risky customers that we need to manage in a different way to the other sets of customers. You know, there's a lot of challenges around it, a lot of new approaches, and I think we're at the pivotal stage now where actually we can collectively really improve what we're doing, and I think that's what we'll discuss a little bit more about.
That's a good intro, and maybe Shaun, I'll come to you next, but just in terms of what some of those challenges are that Colin's just sort of inferred there, what from your point of view, what do you see out there as some of the key challenges right now?
Well, I think it's widely recognized there's not, you know, the compliance framework is very, very broad, and you can't use a single component on its own. So if you look at the current geopolitical situation we have, all of the focus went straight away to sanction screening, and we must sanction those people. You know, we must add them to the EU list, the OFAC list, the UK list, which is a pretty blunt control, right? Because on that basis, you are relying on said individuals using their own named accounts, and we know that doesn't happen. So where transaction monitoring has always been very, very important is around behavioral controls, and really understanding not just the customer you've onboarded, what their name is, what their pattern of behavior is, but actually what are they actually doing, and how are they sometimes circumventing other controls that were within the compliance framework. So I think transaction monitoring has always been super, super important. I actually think with the situation that we've seen over the last few months, which is a terrible situation, but I think it's brought to light, at least for me anyway, that you can't rely, even from a CTF perspective, just on transaction screening. That's where transaction monitoring has a big role to play, but you need to use, and I will sound like a broken record, so we're 7 minutes in and I apologize, but I don't. You have to utilize the technology that works for these type of things, and rules-based architecture for transaction monitoring is not very effective when you're looking at a large amount of data. Stop there.
Just to kind of build on that, I would say that fintechs really struggled in the first months of COVID with the epidemic of fraud, and that was an example of how crucial it is to be agile where in your transaction monitoring system. So a lot of fintechs at that point had to implement transaction monitoring, not just for AML purposes, but fraud prevention, or they would be actually suffering a lot of loss there in terms of reputation and financially. So it's extremely important. Again, another thing I will bang on about is that tech solutions can be agile, but governance sitting behind it needs to be agile as well, and triggers for that governance.
And Andrew, from your perspective as well, obviously you look at it, transaction monitoring, from a slightly not unique perspective, but the correspondent banking type-esque situation that you have, say, your current employer, it has its own unique set of challenges, I would say. What are some of those that you would sort of highlight from that area?
Well, as mentioned, we don't have a relationship with the end user. Therefore, we have to sit behind and be somewhat of a gatekeeper of a lot of information coming from a lot of different fintechs with different product types. So we have to build up a really good management information system to be able to deal with this. And like I mentioned, be agile to these various risks that are facing fintechs. And again, we need to basically look at the old-fashioned challenges there around, you know, false positive numbers, for example. Sometimes it's more difficult to prove false positives when you're not having that information to hand, and so that tech solution is important, but also building up good systems and controls around obtaining that information from your so-called respondents, the fintechs we are servicing, needs to be done as well.
Colin, like Shaun just raised two interesting points, which I think be relevant from your point of view as well. Obviously, you're looking at it from a fairly holistic point of view at the moment, and Shaun was saying, look, there's no one product out there today. You need to be quite specific about how you use the technology, and also rules-based is no longer is not fully fit for purpose in terms of a transaction monitoring as a solution. What are your sort of views on those kind of points and how you think about it as well?
Sure. So, and also I think there's a key bit Shaun picked up on, around the use of CDD, customer information in TM. So traditionally, if you like, TM's been quite restrictive. It takes in some customer data and transactional data, but much more, in real time, near time, how are we linking TM and CDD, and then on to the next bit of a question, what tools are we using to do that? And I think ourselves, like many peer banks and across the industry, are saying, right, there's now a whole host of new innovative approaches here. Rules-based detection has been around for a long while, and it has evolved a bit. A lot of large banks are still going to be using that. So I think the initial thing is how you augment that, how you build on top of it. And there's a couple of things there. You may say for certain areas, such as correspondent banking, trade finance, markets, will use more tuned in data analytics led solutions around those. And that deals with special, more high risk areas where often you have less information, to Andrew's point, really. And then, how do we move beyond that, and how do we apply analytics across the board? Some of it is post detection, so we might still use a rule-based system, but then what you get out of it, you put into your models and you manage it through your models. And one other thing I think where maybe rules don't work well, they don't because they're set up against particular threats, is the unknown unknowns. Okay, so you're detecting what you know currently, but actually in your data, and now you've got a bigger data set and a bigger view of customer activity, are the threats, patterns, activities that actually you were unaware of? The thing with a rule-based system, you need to tell the rule-based system what to look for, so it implies you know it. But actually coming through, there may be risks and activity that you don't put together. So I think most, banks of our size in this space, peer banks, are implementing, either fully or through proof of values, proof of concepts for particular areas, more analytics-driven solutions, definitely.
And maybe I'll just come to you, Shaun, in terms of building on that kind of view of bringing in different parts of data, and uncovering maybe unknown threats as well. How have you seen like the technology side of things helping to enable that?
Yeah, so I think fundamentally the unknown unknowns comes from artificial intelligence, and it comes from a specific part of the artificial intelligence, which is unsupervised machine learning. And there's many vendors, by the way, in the market that talk about the unknown unknowns, but I think just as a bit of a tip, really, if they're not talking about unsupervised machine learning, they're not going to identify the unknown unknowns. So I think that's the first thing that I would bring out. I think the second thing is building on what Colin was talking about in terms of the banks going to more of an analytical approach. Every financial institution, I'm not even going to say every bank, every financial institution has now understood and accepted that rules-based architecture isn't fit for purpose. Now, if you are a new bank or a new fintech and you have no customer data, then rules are absolutely fine because you don't have a choice, right? Because the models can't do anything, it needs data. But if you're a financial institution with more than 6 months data, you have accepted that you will at some point move to machine learning. And I think that's an important point I want to raise, by the way, right? So this isn't a question of will it happen? It's a question of has it already happened, or when is it going to happen? We deal with banks, we deal with fintechs. There's no kind of, if you went back 5 years ago, there's all, is it a black box versus white box? That was a really topical conversation that is actually very easy to overcome. But I think one of the things that has really helped, and Andrew spoke earlier a little bit around governance, but I think the regulators are actually helping the situation now. So in the last 5 years, they haven't, but in the last 2 or 3 years, the regulators themselves have started adopting AI. And they've started mandating that, therefore, the people that they supervise have to follow suit. I think that's an important step.
Also, I think financial institutions shouldn't be afraid of integrating things that traditionally sat in different silos. For example, transaction monitoring, negative news, traditionally being done in singularity. Whereas I think any financial institution should look at putting their transaction monitoring system, feeding the high-risk cases into automated negative news screening, and that will have a lot of interesting results. And there's a lot of data out there. For example, 𝗵𝗵 has fraud data. If your organisation is particularly vulnerable to fraud, you can leverage 𝗵𝗵 on an automated basis via a transaction monitoring system.
And maybe asking Andrew and Colin, sat on the financial institution side of things, when you're thinking about, Shaun saying that the regulators changing their view on AI and machine learning and pushing for this slightly more now, how do you see that conversation internally, and how you also want to face off to the regulator more generally? What are some of the concerns that are still brought up internally? What do you need to overcome to kind of, use some of these more innovative technologies that are out there today?
I think the MLRO has to be able to explain the solution in clear terms to the regulator, both the tech behind it and the rules that are deployed by it, or various other techniques that might be deployed by it. And I think there is some way to bridge the gap in terms of MLROs increasing their technical understanding, and also providers being able to provide an overview of their product in a kind of clear term. So I think sometimes providers can approach it from a rather overly technical basis, and they need to be able to explain what they do in a more clearer, non-technical focused way.
Yeah, and adding on that, I think it's also the fact that, traditionally it's been easy to explain inputs coming in and the outputs you're expected, and how map it back against your threats and risks. And we need to do the same in a modeling analytics environment as well, and get to a level of consistency that the results aren't fluctuating or changing, because you as an organization will have your risk appetite, and you need to be able to say how that risk appetite and the threats you face are managed through consistently. And I think that's quite a key part of it as well.
Colin, from an internal point of view, obviously, you're sat there with sort of strategy and innovation hat on, and trying to drive new change through the organisation. What are some of the challenges or some of the main challenges that are bubbling up from trying to innovate in this space, or trying to push
I mean,
holistic view?
some of it with any organization, large or small, is that you're trying to change where you're trying to run as well. You're running the bank and changing the bank. So that's a piece of activity. Secondly, we're in a regulated environment. So where, like in other areas, maybe you could act changes and see what the outcomes are, we need to be quite careful how we manage and implement changes, because you are in a regulated environment. Then a lot of it, and it will depend on the organization, but I think a lot of banks, particularly our peer banks of this size, would be similar. It's how enabled is the organization to take advantage of new innovation. Is it a different skill set? Have you got enough of that skill set internally? Are you using a supplier consultancy to help you with it? What about your own data? What work do you need to do internally? So it's aligning yourselves internally that you can adopt and make use of the new innovation approaches. And Andrew said, particularly how you can explain it in a regulated environment, where there's pressure to do that.
Maybe I just want to sort of maybe step back a little bit, because we've jumped on around a few topics, but maybe Shaun, coming to you, I just want to ask, for those people attending who might just still be on let's say a rules-based system which has been around in their organization for a while, when we start talking about bringing in CDD data, bringing in the new technologies as well, what are some of the specifics or examples you could give about what data we should be thinking about, or additional data we can be thinking about, and the technologies? What would you just sort of, in terms of bringing people to a good base of knowledge there?
Yeah, sure. So I think in terms of different types of data, we've talked about KYC data, right? So I think everybody will understand what KYC data is. Obviously, the more there's a balancing act, right? So the more data you can get of your customer, the more powerful it is for an analytics tool, but the more friction you're put in the onboarding process. So I think as much data as you can get within I guess the appetite you have. I think in terms of other data sources, Andrew mentioned adverse media earlier. I think that's quite interesting because adverse media maybe 5-7 years ago was very much part of the onboarding process of a customer. So are they a sanctioned individual? No. Okay, do they have any friends that are, basically, right? Was the open source check, are they linked in a news article with somebody a bit dodgy? That's what people used to do. I think then it came over to transaction screening. So firms started utilizing adverse media within sanction screening. And now it's moving over to transaction monitoring, which I think is very, very powerful. But again, what I think one of the most important things with whether it's the data or the technology, and it's building on a little bit Colin spoke about just, is you need to have the knowledge within the organization. So I've seen lots of companies, and I'm going back 5 to 10 years ago, is they see the shiny little apple, right? All new technology, must have that, it's gonna be great. But they have absolutely no idea how to use it, right? So I think actually having the internal resource, and I'm talking here not necessarily technology people, because I'm sure every organization has good technology people, but having somebody that fundamentally understands the product. What does it do? How will it integrate into your own data sources? How can this be explained, to Andrew's point, to the regulator? Yes, vendors need to help out in that area, but actually you're the financial institution. You're the institution that's going to get fined or slapped wrists if anything goes terribly wrong. So within your organization, you guys need to actually be prioritizing onboarding the right level of resource. And a lot of that resource is product resource. I think that's important. And then just the only other thing I'd say very, very quickly is the Danske Bank scandal taught us one thing, right? And the Danske Bank scandal taught us one thing, and that was basically that if every financial institution in the world compared their customers and their subsidiaries against GDP data, Danske Bank wouldn't have happened, right? So I think there's so much data, but there's also, you have to take a look at what's the most relevant data for your organization. So if you're a correspondent bank, GDP data is probably quite important. If you're a retail bank based in the UK, it's not at all. So I think understanding out of the myriad of different data sources that you could choose, which are the right ones for your business, is important. And then just the only thing I would say really, really quick is people talk about machine learning, right? Machine learning at its primitive form just removes human bias from decision making. So if you think of rule systems are really good because they are programmed by the people that ultimately write the policies within a financial institution. So it's going to be consistent with governance, you would suspect anyway, first of all. One of the problems though is they can't identify something that they're not aware of. So if I am writing a rule into a system, but I'm not aware of this risk over here, that risk is that's going to happen in my transactions, right? So that's where actually machine learning is quite important, because it doesn't have any bias in its decision making. And as long as you train the models right on the correct typologies of risk, which again, clever people in terms of the organization will do that, then it will identify the unknown behavior you're not aware of.
I just want to touch on Andrew and Colin, again, from your perspective, sat within the financial institution, as you're thinking about, moving into, bringing in more data and potentially how automated you can make things versus how manual things might be, and ultimately the workload that's generated off the back of that. How much of it is concern, when we talk about, say, let's take adverse media as an example, like when to use that information, how to use it effectively, how not to burden the operations, too heavily in this process. What are some of the thoughts as you go through this around the operational side of things?
I think things like negative news or adverse media, as you might call it, screening, it's quite a resource-heavy task. So it should be applied on a risk-based approach. So as I mentioned, for example, a transaction monitoring system, identifying high-risk activity, potentially the parties can be screened automatically by negative news, and also that could also leverage kind of other higher risk situations in ongoing monitoring due diligence, so the screening of negative news information for direct customers. So I think you should basically think carefully around what you do with the technology, and also the high risk situations in your risk assessment that you might want to apply such processes.
And building on that, I think, it's also where in the process you use the data. Lots of different types of data. Ideally, you want to use it upfront as you produce an event. So use it in your analytics, your alert production, but you get less alerts. But let's say you can't do that for whatever reason. Can you use it post-event production to say this extra bit of information, such as Shaun has mentioned, the GDP, will help either, confirm an alert, an unusual, or actually close it out because it all correlates correctly as we'd expect. And you want to do that in an automated fashion so that you're using the data as part of your alert generation or post-alert generation. And then the third bit, and going on to what Andrew said, and where you have to be more careful is giving it to investigators and analysts, because it can be quite time consuming. And if you give it too early, too soon, people could spend a long time closing out an alert, which actually should have really been closed out anyway quickly. So you have to train your investigators, analysts, others to use that information carefully. But generally, the more you can automate, the less coming down the line, and also the more accurate it is, which gets there. And then, as Andrew said, you try and do that on a risk basis as well.
Clearly, you guys all, come at the problem from a slightly different angle, and that might be slightly unfair, Colin, because you've got to look quite holistically across everything. But certainly, product from Shaun's point of view, and MLRO compliance from Andrew's. When you're thinking about transaction monitoring, there are so many different components that need to come together in terms of data, technology, governance, as well as the sort of functions. It appears to me this is not a simple challenge to crack, and we're sort of sat here going, do this. Can we talk about the journey that some of you guys have seen at maybe different organizations, maybe your current organization? Shaun, you get a good view across the market as well. How the journey should look here. Going from sort of where should you start this journey, where should you focus on to start with, and how do you move through that journey in terms of building up your sophistication over time? Where should we go first? Shaun, go for it.
I'll give the guys. I'll do a broad view then. So I think it really depends on I would say, the culture of your organization. So if you are a organization that is, say, a fintech that started in the last decade, then I would highly suspect that you are either already on your journey towards AI or you're about to go there. That's the first thing. So you may have started with an in-house built tool. That's one thing we see quite a lot with fintechs. They've got really, really clever developers. They've got a product person that maybe used to be the co-founder when they first started, and they know best. So therefore, they've built their own internal system. What they find pretty quickly after the regulator pays them a few audits is actually it probably ticks the box in terms of having a control, but it needs to be a little bit better. So, but those type of organizations will move straight to AI. There won't be a middle ground in this at all. And when I'm talking about AI, you've obviously got semi-supervised and unsupervised. Now, unless you're replacing a legacy rule system, there's no point using semi-supervised machine learning, because all it's going to do is automate some of the really rubbish alerts that are actually being generated for you. So it's pointless. Whereas actually for large banks, I think what I see is there's two different buckets they sit in. And I don't mean to put banks in buckets, but I'm getting it right. So I think you've got the innovative banks, and I'll put, the BBVAs, the Santanders, present company obviously included. And I think with those guys, they will have started on rule systems, because that's what the technology approach was a decade ago, maybe 2 decades ago. And as Colin said, they would have actually iterated over time. So those rule systems would have got smarter. There's no doubt about that, right? But over the last 5 years, they will have embarked on a strategy towards AI. And, there are examples. Santander is a really good example. They've fully adopted AI and unsupervised AI. There's some actual banks that are on that journey. Some are already there. But I think if you're a bank, you've started in rules, you're moving over to AI, but there are actually there's the other bucket that I wasn't going to talk about, and that's the really slow movers. And, they are still on a rule system because their regulator still sees it as a tick box. Now, I think there's two problems with this, if I'm perfectly honest. First problem is you're gonna still process funds which are ultimately result of criminality, right? There's just no doubt about it. There's more bad stuff that's going to get through if you use a rule system. The second thing is you're probably going to get fined by the same regulator that's okay with you using that as a tick box. That's probably going to happen. And the third thing is the banks in the other bucket over there that are probably sitting quite smug on their journey towards AI will have a competitive advantage against you. And the reason that I mean it's a competitive advantage is if you can, we'll talk about risk, right? Because there's, we all have a risk background. So there will be a level of risk that you're, let's say Andrew in this example, is comfortable taking. If, and I'm going to bring a revenue element to compliance, if you can increase Andrew's risk appetite, so therefore allow him to take on higher risk business or go into countries that he couldn't go in before, you're going to increase the bottom line of the company, right? So you're going to onboard more customers, you're going to have more transactions, you're going to have more revenue. That is a competitive advantage. And the reason I mention this is through the use of artificial intelligence technology, banks have seen they were able to actually increase the risk appetite within the business and therefore actually attract more revenue. So it's a bit of it's a strange one for people to hear about on a webinar about transaction monitoring, but it can actually be a significant revenue driver in terms of the adoption of AI.
So I guess coming to you, Andrew, maybe first and then Colin, but in terms of that journey that we sort of were just talking about there, how do you think about building up the sophistication from your point of view? And I guess there's a touch on the point that Shaun was just raising there about how do you build that business case, or how have you built business cases for investment in this space? Have you used the revenue argument before? Is it more sort of on the compliance angle? It'd be great to hear your thoughts.
Well, I think from an MRO perspective, your first step is always risk assessment, firm-wide AML risk assessment. Having that documented, having a solid methodology there is your first kind of cornerstone in your AML framework. And then attacking transaction monitoring from there, you should be able to basically tie in your framework in terms of transaction monitoring and the underlying rules to the risks that you face as a business. And then sitting below that, you have governance, including regular kind of discussion with the higher ups and the board, and also generation of management information for them in order for them to make those agile decisions, policies and procedures around not only the governance, but the kind of operation of the transaction monitoring system, review of the transaction monitoring system, analysis around the resources to actually operate the transaction monitoring system, both on the kind of the amount needed to be able to deal with alerts in a kind of acceptable time frame, and also the expertise of those operating the system. And then you kind of look into also the technology, obviously optimizing current technology, but is other types of technology needed to actually increase that bottom line? So LHV services a lot of crypto firms, which is obviously the subject of a lot of vigilance from the regulators there. So we've looked into kind of more kind of industry solutions, actually deploying blockchain monitoring on not only in the background, but on transactions as well. Things like that. But basically, you can actually argue that we can increase the onboarding of a more varied range of those crypto firms by deploying such solutions.
Colin, do you want to build on that, or maybe sort of one of the specific questions I was posing around sort of the business case side of things? I wonder, given you're sort of on slightly more on that change side of the world, how you guys are approaching that.
I mean, it's as Andrew said, really, and it's sort of both sides. Primarily, it's the compliance. You need to be compliant. You need to manage your risks. You need to demonstrate to the regulator that your controls are effective and that you're improving them. But definitely, with any organization, but especially when you look at large banks, compliance is a significant cost, both in day-to-day running costs, but also, as Andrew and Shaun said, if it prevents you doing business, you would be, bringing in revenue because you can't understand it, you can't monitor it, you can't risk assess it correctly and manage it, then that's a missed opportunity too. So I think, you know, it's moving compliance from being a brake, if you like, to an enabler, as Shaun said. You know, at the moment, it's almost like you're trying to go faster with your foot on the compliance brake, but you want compliance to say, yeah, we're happy with that. You can take on this new area, this country, this type of customers. But I think at the basis is always going to be, you know, managing the risk, being compliant, being able to demonstrate that.
Maybe Colin, maybe staying with you just for the next question. In terms of when we think about people, you know, what are some of the, this is a quickly evolving area in terms of threats, in terms of the technologies used, in terms of how the process is run. What are some of the people considerations that you're actively thinking about today as you think about that? And maybe also what you think people in this function will need to be thinking, you know, what they'll need to be doing more and more of in the future as well.
So, you know, there's two sides to that, and sort of Andrew alluded to earlier. You know, on your side, the people who manage and oversee those tools, you know, with rule-based systems, it's fairly easy to understand them. But if we move into more modeling, working with vendors, you know, suppliers, what skills do you need? Data scientists, people who can do the validation and modeling, your own audit teams, how are you enabling them? So that's part one. But then on the investigation side, you know, you evolve into what I'm phrasing, and we're starting to use intelligence-led investigations, analytics people, you know, so whereas before they're looking at maybe alerts in singular, looking at transactions, looking at a bit of customer data, it's about this holistic crime management. So it's more of an investigative operation and activity. You know, they shouldn't be going around gathering data, looking at transactions. That should all be presented up to them by systems, and they should be looking across CDD, TM, other areas. It's actually true financial crime, intelligence-led monitoring, understanding the threats, the evolving threats. So it is an evolution. As Shaun and Andrew said, you know, it's not just about putting a system in and expecting it all to happen. You've got to evolve the organization to be able to accommodate it. And yes, data technology side, I think people get that, but actually it's a lot more involving your people who are looking at the outputs from that and the way they deal with it.
And just one follow-up question, if I may. In terms of, you know, we're talking about people and changing, you know, this to a more holistic financial crime. Do you feel like that necessitates organizational change as well in terms of how teams are actually structured today as well?
Yeah, and that's an evolution. You know, initially it's probably more what firms say synergies. So sharing data, whether that's CDD, TM, fraud, sanctions, you know, bringing that data together, sharing that knowledge, working more collaboratively. But in the future, is it moving towards people who can deal with all of that and have systems who can present all that to them? So again, it's an evolution, but definitely I think some of those silos we've had in the past, especially in large organizations where, you know, they've had fraud and fin crime and sanctions, AML sanctions, those all separate areas, A, B, and C, are starting to say, well, hold on a minute, we need to bring all this together under that umbrella. Yeah. Easier said than done often, but yeah.
And but just to add to that, you know, we're currently undergoing what's called the Great Resignation. So it's crucial that firms deploy their staff in what's interesting work, as least manual work as possible, because it's hugely expensive and damaging to organisations to have a high turnover of staff. And you know, the regulator will look at that if that's the case as well. So you should avoid that if possible.
Well, also, you know, you're employing someone to say, oh, this is a fight against financial crime, and you have all this internal training and education, and the CEOs of these firms saying, you know, everyone, we're fighting financial crime, and people say, well, I'm filling in spreadsheets and doing Google searches all day. It doesn't quite feel like it. So, you know, as Andrew said, you want to remove all those hygiene factors that their job becomes more interesting, but also more focused and purposeful as well.
Absolutely. And just as a quick reminder, we've had a question come through, which I think has been answered on the chat, actually. Feel free to keep posting your questions there, and we will pick them up and discuss them as well if required. Just in terms of how transaction monitoring is going to kind of evolve, and I think we've sort of been alluding to a number of these things over over the course of this discussion, but as people sat here today and what we see today, how is this function, how is this what we're doing around monitoring going to be changing over the next sort of couple of years, maybe even sort of in the longer, sort of more medium term, maybe 3 to 5 years as well? What are sort of, maybe Shaun, coming to you first, what are some of the main changes that you see happening across the industry?
Well, I'm going to not talk about AI for a second, so I don't seem like a broken record. But it's terribly important. I think one of the areas is network analysis, right? So when we're talking about investigations, then you can provide a piece of information in a tabular form for an analyst to review, and that's what most systems do today. However, you can use a graph database, which will then provide a more pictorial view. And rather than looking at a transaction from Shaun to Colin, it will actually show that Colin's actually receiving loads of transactions from Andrew as well, who in turn is actually sending transactions to Shaun's dad. Unusual, I think you would all agree. Might be a reasonable reason for that happening, but you would not see that in a tabular view of a transaction. So using graph databases, using network analysis, I think certain people do it well today already. If people don't, then they're going to need to quite quickly. I think another area, Andrew spoke about crypto before. So, it is seen as still, I think incorrectly, as a high risk industry. But I believe it's only seen as high risk because people don't understand the risk and they don't have the tools to actually control the risk. So I think you'll see a lot more finance institutions feel comfortable accepting flows that aren't just from exchanges. So I think there will be an increase in crypto and also then just wider blockchain use cases. And I think there'll be use cases that actually solve a problem rather than the creation of a use case on blockchain that's looking for a problem to solve, which is what we've had over the last decade. Other things, I think, transaction monitoring, we spoke about how it's one component within a larger process. You don't have to have a single vendor that does everything. That's not my point. I think it's actually quite a useful exercise to have multiple vendors that specialize in certain areas. But you will see that vendors either go through M&A activity, because when one of the, let's say, the large legacy players come under threat, their first action is to just acquire other providers, which is actually the worst thing to do because you stifle innovation. But either way, I think you will actually get more of a holistic end-to-end process. So I've mentioned network analysis, SAR reporting, getting the analyst all the way through from the start to the end of the process in a specific place, whether it's through one company or multiple, is a good thing. And I really, really hope, this is my last point, I really, really hope that what Colin was saying really happens. So financial institutions start hiring intelligence-led people, and we don't have to hire, and I've done this role myself, right? And I'm sure most people have that are on this webinar, that we don't have to have people that are sitting there looking at something for 30 seconds and realizing it's a complete and utter waste of their time. We need to be actually using technology to provide alerts that are actually meaningful for the analyst to review. And that then allows them to be redeployed into more interesting roles. Lots of mistakes, by the way, lots of SARs that have failed to be raised are because the individual that should have actually reviewed the item is reviewing 500 items the same. Think of what you would do yourself if you have to review the same thing over and over again. We need to actually challenge people, and the only way you challenge people is using better technology.
Good points, lots of them. Andrew, from your perspective, and I'm sure it's a little bit different as well, given where you sit. What are some of the key things that you're thinking about might be going to impact us?
I'm just praying that the regulators allow easier data sharing between organisations and jurisdictions. I think that will be a key point for FIs in the future. Essentially, if you're not leveraging data from outside your organisation, you're fighting with one hand behind your back. So, they should basically deploy more resources looking into solutions that allow to review data outside the organisation.
Do you think it's a realistic prospect?
It's more hopeful than realistic, I believe, especially in the light of Brexit. But I still think that even, within the UK, that institutions can deploy solutions such as MITS that leverages data from outside the organisation, so that fraud data and such. So even if the regulators don't play ball, hopefully organisations can take it under their own steam to make these changes.
Colin, maybe building on that and bringing in your own views on what the future's holding, but what we're talking about there with Andrew is even more data, more complexity. Ultimately, will that bring greater effectiveness? What are some of your thoughts on the future?
Yeah, and I'll come back to the sharing a data point in a moment. I think it's it's this intelligence-led approach. So analysts move up to being intelligence analysts. It's this holistic view of financial crime, using more data but using it intelligently. And I think the point, and Andrew's hit the nail on the head. If you only see your side of the transactions and your customers, you're hamstrung about what's going on. And whereas before there's issues around sharing of data, I think technology is now allowing data to be shared in a much more protected and safer way between organizations. And I think with data as a whole, like we said, it's great to have a big data set, but you need to use it thoughtfully and pinpoint how you're using it. And with data sharing between organizations, that's definitely one. But I think collaboratively across the market space, firms are aware of that and that it will improve financial crime detection for all of us. So yes, definitely.
Okay, brilliant. And I think there was a question on the chat here, but I think we've probably, I don't know, Shaun, if there's anything you would like to add to. I think we've kind of covered some of 𝗵𝗵𝗃𝗵𝗃 here, who's asked a question about data sharing that may lead to having needing more complex AI. Is that a correct assumption?
I think the more data you have and the more data equals more complex models, but more complex models will actually be able to identify more elements of criminality. If you look at, if the Netherlands can do it, right, and the Netherlands have built a transaction monitoring system for all of the banks to use, isn't that a good idea, right? And I'm saying that from a vendor's perspective. So just think about that. But from that perspective, they can share data, there's consistency of approach, and the DMB themselves have a lot of control over that process. So it won't work in every territory, thank the Lord, but actually for the Netherlands within their specific ecosystem, it works actually very, very well. So easy answer is yes, but I think the Netherlands is a really good example of where data sharing happens really well. There's actually, by the way, with transactions moving away from SWIFT, I know that the global payment systems actually come into fruition. There's other companies now that are actually specializing in the exact point we're talking about, i.e. data sharing. So if banks don't feel comfortable sharing data to another bank because of the point, i.e. losing customers, and I think that was the point that was raised as well, actually you don't have to worry about that because you can actually have encryption via another company in the middle that does exactly what 199 through SWIFT would do, for example. So I think there's solutions out there. People just need to know, and it goes back to my point about having the right resource in your organization. If you don't know about these things, you'll never implement them. But if you have the right people within your organization from a compliance, product and technology perspective, then you'll be able to make the right steps forward.
Okay, very good. Look, I think on that note, look, I'll say thank you very much to our panelists, and thank you for joining us today to listen to this webinar. And please do get in touch with myself or any of the panel if you'd like to ask any other questions. And on that, I'll just say enjoy the rest of your Tuesday, and thank you again. Cheers then. Bye.
Thank you.
Thank you.
Thank you.